I forbindelse med at vi har publisert en ny episode i dag på Patreon, så legger vi ut en episode vi tidligere har publisert på Patreon. Hvis du ikke kjenner til Patreon, så det er vår betalkanal. patreon.com/tid-penger hvis du vil se på mer. Vi er også tilgjengelig på Spotify. Sånn som alle vanlige podcaster tilgjengelig til Spotify. Tidligere har det ikke vært mulig å ha Patreon knyttet til Spotify. Nå har vi gjort det tilgjengelig. Du kan bare søke opp Tid-penger, så finner du 2 show. Der du ser bilder av logoen, det er vår Patreon-konto. I dag skal vi snakke med Paolo Pellegrini, eller det er den episoden vi gjorde for cirka et halvt år siden. Og det er jo mannen som arkitekten bak kanskje den beste traden noensinne. Og på vår Patreon-episode den nettopp har publisert, så var det en journalist som har skrevet, Pulitzer Price-vinner journalist, som har skrevet en bok om Private Equity. Meget interessant. Da klipper vi inn til introen vi hadde for et halvt år siden. Ja, da har jeg gjennomført et intervju med Paolo Pellegrini, en mann som står bak det som man kan argumentere er den beste traden noensinne i historien. Jeg vil i hvert fall argumentere det. Han hadde ideen til det som ble John Paulson sin short av hele det amerikanske eiendomsmarkedet i praksis i 2006. Så han startet ikke først, men de hadde den største avkastningen. Fondet til John Paulson steg med cirka 10-gangeren fra $3 milliarder til $36 milliarder i perioden. Og vi har da fått snakket med han nå i en time og fått høre detaljer om hvordan det var. Hva du synes om det, Peter?
Jeg synes det var kjempebra. Jeg traff jo John Paulson før, jeg tror det var i 2005, altså før de satt på den der traden, og jeg føler jo på en måte at hadde det ikke vært for Gregory Zuckermans bok, så hadde jo på en måte Paolo Pellegrini nesten vært ukjent for de aller fleste, fordi det var jo Paulson som på en måte fikk, også fordi fondet selvfølgelig, eller forvaltningsselskapet hadde hans navn, som på en måte fikk all æren for den fantastiske avkastning de skapte. Altså, jeg mener at var det ikke i 2008 alene så tjente de noe sånt som $20 milliarder. Det var liksom, Paulson tjente vel 4 milliarder.
12-gangeren på det ene fondet, 6-gangeren på det andre fondet, og så hadde de en rekke andre inntjeninger på det.
Ja, nettopp. Ja, det var liksom
pluss dem som ble inspirert av det her, som også tjente vanvittig mye.
Ja, altså det var jo altså alle de som på en måte shortet både boligmarked og en rekke andre ting på det der tidspunktet, ble jo motarbeidet av investeringsbankene som hadde posisjoner den andre veien. Altså for investeringsbankene stilte jo dette ble gjort med noe som heter credit default swaps, og som kan ses på i hvert fall for enkelhets skyld som en put-opsjon på kreditt, altså på kredittobligasjoner.
Brandforsikring på naboen sitt hus, er det også noen som kaller det?
Ja, men altså, jeg vet det at den kritikken kom at liksom, man skulle ikke få lov til å gjøre det, men det er jo det du gjør, altså hver gang du kjøper en put-opsjon, altså kjøper du en put-opsjon på Equinor, uten å være aksjonær i Equinor, så er det jo akkurat det samme. Så jeg kjøper ikke det der argumentet, men bankene og en del andre, blant annet Warren Buffett, altså som med hans Berkshire Hathaway, utstetter jo disse CDS-kontraktene hele tiden for å få inn premie. Fordi det er det du betaler når du kjøper en sånn CDS-kontrakt, så betaler du som regel halvårlig eller årlig premie på den, og en CDS-kontrakt er sånn typisk alt fra 5 til 10 år lang. Du kan få de kortere også, men det var liksom det som var vanlig å kjøpe 5 og 10 års CDS-kontrakter. Altså investeringsbankene tjente voldsomt med å legge ut disse her, og utstette disse her veldig mye på egen bok, og det samme gjorde blant annet Warren Buffett, og så smeller det fordi du får, i Paulsons tilfelle da, så faller boligmarkedet fra hverandre, og boligverdiene absolutt tryner, og disse lånene, altså det man hadde gjort var å ta boliglån og sette de sammen til slik at du fikk liksom en portefølje av lån, og så fikk man disse kredittratingsbyråene. De var totalt korrupte på den tiden. De aller største navnene som man kjenner var totalt korrupte. Fordi man satte sammen en portefølje av mange nok navn. Glem det at alle var avhengig av den samme risikofaktoren. Ikke sant? Altså det er jo greit det at du ved å sette sammen en portefølje så beskytter du deg mot den enkelte boliglånskjøperen eller boliglånseieren som da får økonomiske vanskeligheter, men du er allikevel eksponert mot hele eiendomsmarkedet hvis det faller, så du har egentlig en stor risiko. Det til tross så ga da disse ratingbyråene disse lånene AAA, altså den høyeste ratingen du kunne få. Som om det var null risiko, altså du fikk en rating på nivå med statsobligasjoner. Og dette oppdager jo da Pellegrini, og altså det som greia med han jo, som sagt, hadde ikke vært for Greg Zuckermans bok, så hadde sikkert de aller færreste noen gang fått vite om han, fordi Michael Lewis, som da skrev boken The Big Short, som fikk denne her fantastiske titelen, og som senere ble til en film, han laget jo dette her mye bredere. Han tok jo for seg veldig mange andre som gjorde ting, blant annet Sign Capital, hva han heter, han autistiske legen.
Michael Burry.
Michael Burry, nettopp, ikke sant? Han tar den.
Men det var jo en del oppspinn, en del, ikke oppspinn, men en del manipulering av dataen for å lage en bedre historie, og det som så dumt det jo på grunn av filmen og på grunn av Brad Pitt og alt sammen, så tror folk at det storyen.
Ja, så den storyen ikke helt på jordet, men den ikke presis på noen måte, og den får ikke liksom frem akkurat hva som altså den virkelige historien kommer ikke frem, ikke den granulerte historien, den som i detalj kommer ikke frem. Det blir mye sånne generaliteter i den, og filmen jo fornøyelig den, jeg har ikke noe problem med den. Men Paolo Pellegrini, han var jo på en måte hjernen bak dette, og begynner å sette på denne traden allerede så tidlig som i 2006, men han klarer å gjøre det på en måte hvor de har positive carry, altså med andre ord, i stedet for å betale hvert halvår eller hvert år, som jeg nevnte, premie, og dermed ha en netto premieutlegg og et tap hvis ingenting skjer, så hadde de andre ting de investerte i som på en måte betalte for denne beskyttelsen. Det litt som Boas Weinstein med Saba Capital gjør i dag. Boas var for øvrig også aktiv under finanskrisen. Og derfor synes jeg det veldig ordentlig at Pellegrini kommer frem, og jeg synes det fantastisk at vi eller du fant frem til han, rett og slett du du som fant frem til han, jeg nevnte navnet og du fant frem til han, og det som slår meg i intervjuet at han jo utrolig ydmyk, han veldig lojal i forhold til, altså han skilte lag med John Paulson etter dette, startet sitt eget hedgefond, som ikke lykkes, altså det litt sånn one trick pony, ikke sant? Du finner den der ene traden, og den går inn veldig, og så har du vanskeligheter med og så forsøker man å gjenta den suksessen, og i mellomtiden så forandrer markedet seg. Dette har jo skjedd med folk gjennom tidenes morgen, men han lojal i forhold til Paulson og de uenighetene de hadde etter dette, og det var jo dreide seg litt om fordeling av altså bonuser og suksesshonorar og den type ting. Men jeg synes
han har historiens største analytikerbonus. Vi vet jo hva det men av respekt for han så skal vi ikke dele det.
Ja, det har han nok, men i hvert fall han starter for seg selv, og han starter sitt eget fond, og nettopp fordi han akkurat gjentok den samme handelen som da i et marked som endret seg, så ble ikke det noe suksess, og nå, så vidt jeg forstår, driver han i en helt annen bransje, men han jo da godt bemidlet, for å si det forsiktig, og en sjarmerende fyr. Så
Nei, altså han var veldig uventet, og fikk det, for at når jeg satt og researchet han før, for det kom litt sånn plums på hele intervjuet, og det som slo meg var at jeg tror kanskje han hadde veldig behov for å snakke om det her. jeg tror han hadde irritert seg over filmen The Big Short, og bare det er det poenget at de på en måte stjelte navnet fra traden, for Big Short var John Paulson sin short.
Ja, absolutt.
For altså, nøkkelordet der er big.
Ja, nettopp.
Og det er ikke om å gjøre å være først. Zion Capital var først, det sier han jo også. Men, og de kjente jo ikke til det da, men det er ikke om å gjøre å bare være først, det er ikke det som er en trade. Å være early og være wrong, og det fikk jo Zion Capital oppleve også, at de tappte jo masse oppsider og bærte jo utrolig mye kostnader frem til det endelig lykkes.
Ja.
Sånn at det her synes jeg er minst like mye en studie i teknisk gjennomføring og forståelse av instrumenter på et dypt nivå som ingen av de andre som også tok æren, sånn som Green for eksempel, og andre som så vidt blir nevnt i intervjuet. Så bare veldig fascinerende å høre.
Ja, jeg er helt enig med deg, og så tror jeg at det er utrolig fascinerende, og dette skjer jo i finans, fordi det er på en måte de som fortsetter, og de som har altså, stemmene videre, som bestemmer egentlig hvordan historien skal skrives. Og i og med at Pellegrini da er ute av finans, så har ikke han hatt en stemme til å på en måte korrigere, fordi det blir jo gjerne, ikke sant, man sier at det er vinneren som skriver historien, og historien preges nettopp av det. Og derfor så tror jeg at Paolo Pellegrini satte pris på å få lov til å på en måte gi mer color da, til hva som skjedde, og dette er jo en av de største tradene noensinne, ikke sant? Og jeg synes det er viktig at det riktige kommer frem her. I intervjuet du gjør med han, så er han inne på dette med, eller du nevner dette med frontrunning, og hans definisjon av det er faktisk litt feil, fordi han sier at frontrunning er når banken eller meglerhuset tar posisjonen som du skal ha før deg, og så dumper den på deg. Det er jo ikke det, fordi det er jo at egentlig så er frontrunning at de tar din posisjon fordi du har gitt dem ideen, og så kjøper de, ikke sant, til bedre kurser enn det du gjør. De trenger ikke å dumpe den tilbake til deg for at det er frontrunning. Det er jo
jeg tror det er snakk om like mye som lojalitet. At han sier
det er det, men
lojalitet overfor bankene.
Ja.
Så jeg synes egentlig det var litt commendable at han sa det.
Ja, kanskje. Ja, det er det jeg sier, han er jo ydmyk og lojal, var jo to ting som jeg nevnte, men det har jo vært et problem, og det var jo et problem allerede i 98, da investeringsbankene gjorde det sammen med long-term capital management. De duplikerte alle handlene deres og skyndte seg, og hver gang det kom en ordre fra long-term capital management, så skyndte bankene seg å kjøpe for egen regning først. Så dette var jo et pågående problem allerede da, og et enda større problem ble det i 2008, og spesielt når det begynte å gå galt i 2008. Da ble det jo et enda større problem. Men det er veldig interessant å høre det hele fra Paolo Pellegrinis munn, altså absolutt. Så jeg er utrolig glad for at vi kan presentere denne fortellingen fortalt av faktisk arkitekten bak handelen.
Skal vi gå i gang med intervjuet da?
La oss gjøre det.
So I have so many questions, and you're such a name that's so familiar to me, and it's been talked about so many times. But honestly, before I take it you joined Paulson in 2004.
Yeah.
But honestly, I don't know much about your history, and I think many people don't. How did you end up in finance?
Well, I went to Harvard Business School in 1983. Before that, I worked as an engineer in Amsterdam for a couple of years, and before that, I studied electrical engineering in Italy. But after business school, I went to work for a company called Dillon Read, which was a small investment bank that had just gone private. And then after Dillon Read, I went to Lazard Frères, and I was at Lazard Frères for 9 years. And then I left investment banking at the end of 1995. I did different things. I started a reinsurance company in Bermuda. I started a couple of consulting ventures, and finally I got to Paulson in 2004. And, so that was when, I knew John Paulson from a summer job during business school. We had shared office. And so I went to work for him, basically doing the work in the merger arbitrage area. Merger arbitrage is basically investing in both the acquirer and the target in a merger transaction, and essentially betting on whether or not the transaction closes on the terms that have been agreed. And so that's how I got to hedge funds. And I'd say that John gave me sort of a big break, because it's not easy mid-career to go from more of a investment banking and corporate finance sort of like role to one of actually making investing and trading decisions.
Yes, it's a very uncommon route, and it speaks volumes to your abilities, I think, that you're a sort of a multi-talented person. And when you came to Paulson, because the term or the position analyst, it sounds almost junior.
Oh, yeah. I basically sort of like the people I work with were a little older than my children. Because
Wow.
I was 50, they were like 28 type of thing.
You were 50 then?
Well, I was 47 when I joined.
Yeah, it's hard to gauge your age. I've seen videos of you that's quite recent, and I would not have guessed that. So take that as a compliment. And maybe that's part of your secret for coming up with such a both mentally complicated, also environmentally difficult trade, which is betting against pretty much everyone. Can you talk about, first of all, I have to get one thing straight.
Yeah.
So what is the Big Short? Is that John Paulson's bet, or is that the trade in total? Because my understanding is it's John Paulson, right? That is the Big Short.
There's a book called The Greatest Trade Ever, written by Greg Zuckerman, who I think still is a journalist at the Wall Street Journal. I mean, he may have kind of like become just a contributor to the Wall Street Journal rather than full-time journalist. But at the time, he was a journalist, and that was his book, and that was kind of focused on John and me and how we came up with the trade. But so then Michael Lewis did The Big Short, I think, and so decided to sort of kind of focus on more. On a wider range of people, and didn't say much about us because essentially they're being repetitive. But in reality, I mean, sort of like we did the trade in a much greater scale than anybody else. So
that's my point. That's why I want to set the record straight, because when I first heard of the Big Short way back, I remember that the Big Short was related to the size of the Paulson trade, your idea. And when the book and eventually the movie came out, it's sort of a rewriting of history, and you have Michael Burry that sort of is being portrayed as the all-seeing.
Well, I mean, so the thing is, when we started, we sort of had heard that there was a fund. I think Michael Burr's fund was called Scion, and that they had a big position. But they started earlier than us, and then we started on a small scale compared to the size of our fund, and really waited until the end of 2006 to scale up significantly. And basically, sort of, Mike had the right idea, just sort of like his timing was a little early. And so he basically didn't have any powder left to, come in. And he basically lost money for 2 years. we didn't really lose money. We basically were break even for a year, and then were able to raise fresh capital and use other capital that we basically were kind of ready to pounce at the beginning of 2007, and we started building essentially sort of over a few months. We built a very, very large portfolio.
Can you talk about the very first moment? I'm sure you must remember the moment you started either thinking about this, seeing something that inspired idea. Can you talk about what that was like and what happened?
It's kind of like I tend to put together different, ideas and combine them. The thing is, before Paulson, I was at another hedge fund where I was connected with them because they had funded my reinsurance company. So I was there doing a little bit of, let's say, consulting more than trading. And one of the partners there said once was that, when you short a company, there is always the risk of a strategic transaction coming in and really sort of wiping you out. Instead, if you short mortgages, so there's not, once things go wrong, there isn't any particularly good reason for somebody to come and rescue the mortgage. And so that was kind of like the premise, and that was kind of like in the back of my mind. And then, at some point after doing this work on merger arbitrage, John had weekly meetings, where we kind of like discussed, the general state of the market. And his main concern was the state of consumer finance and, sort of consumer balance sheets. And so what they were doing at the time was trying to short the finance arm of General Motors. So essentially, so they were focusing on auto loans as one, sort of problem area. But so the whole thing started slow in the sense that at that point, John was not using any derivatives at all. So the first thing I did was I suggested that maybe we could short derivatives of MBIA, which was a financial guarantee company, and Countrywide, which was a essentially mortgage finance company. And so we started doing that. And of course, there were rumors that at some point that Bank of America was going to acquire Countrywide. So there was volatility in our position. And so at that point, I said, but look, John, if you really want a short that has little downside, we should start shorting mortgage securities. So then we had to sort of learn about mortgage securities. And it was kind of an interesting thing because there were quite different type of securities. And so we started focusing on subprime, knowing very little about it. And there was a whole industry with tens of thousands of people who are dedicated to that business. Was $1 trillion of outstanding assets. It seemed like crazy because the idea is that you had people who couldn't afford pretty much anything that all of a sudden were given these 12 and 13% mortgage loans that obviously, sort of were going to be very difficult to service. And so it was kind of puzzling. And we thought, sort of this is going to go south quickly. But then, so there was kind of like in any trade, the question is, what is the catalyst? And so why are we here? It's not like the market is supposed to be sort of somewhat efficient. So you shouldn't have something so kind of out of whack. And so we basically sort of just started a small short position that was kind of like, I think it was $100 million, 10 different pools of subprime mortgages. And we were paying a 1% credit default swap fee. So basically we spent $1 million a year to have protection on $100 million of.
And this was the CDS on the MBS, right?
That was the CDS on the mortgage, on the BBB tranche of the residential mortgage-backed securities, RMBS. And so,
Can I ask you one thing before we move on? I don't want to interrupt you at all, but it's just a point. So when you say that people were paying 12%, they're getting mortgages with 12% interest. How did you find out this? How did you research your way to these small details? Because I think a lot of the brilliance in this idea is the research. And when you say that casually they were getting mortgages in 12%, how did you know that?
Well, so that's a very good point. And it's kind of like, sort of like the barrier to entry, if you will, in the hedge fund world is that basically, you need people who will talk to you. So John had a very good relationship with Bear Stearns, which was his prime broker. And so even though the Bear Stearns people thought that it was a little crazy, sort of they humored us and they let us speak with their mortgage analysts, and they had a strong bench, and they were doing a fair amount of subprime origination themselves and securitization, and so they were really sort of one of the big players. And so we kind of like got access to the research and then started getting, sort of like if you look on Bloomberg, or at least if you looked at the time on Bloomberg, there was plenty of information about characteristics of residential mortgage pools. And then, sort of like there were services that provided the information. And that was kind of like a significant accomplishment, I would say, over time. But, so after the initial introduction to this class of securities, then we started looking around for what we could do in terms of getting an edge of understanding. And so we ended up essentially buying two databases. One was I think was called Loan Performance, which basically had 6 million subprime mortgages, and they basically had the monthly performance of the mortgages. It was a difficult database to manage. Sort of technically, it's kind of like a lot of data for the technology at the time. So basically, sort of I found a provider who put the whole thing on these database that was optimized for time series analysis. And then we also got the Case-Shiller database, which at that time I think was still sort of sold based on subscription. The home prices can be confusing. So there is a whole methodology that Freddie Mac had adopted, and basically they provided data, but it was data that didn't have a lot of granularity. So instead, we got the Case-Shiller, which had basically zip code level data. And so then what we could do, I can jump to sort of the transition point, the inflection point, if you will, when we went from, sort of having a hunch to being really convinced that this was kind of like an amazing trade. And that was, sort of towards the middle of 2006, because there was this, I went to a analyst conference by the CEO of New Century. New Century was a company that was purely a subprime originator. And so I asked him about the mortgages, because, so there is another thing to be said. The subprime mortgages were issued with a teaser rate that lasted for 2 or 3 years. So a teaser rate would be something where they paid, maybe 5%, sort of interest on the mortgage. But then the mortgage reset, after 2 or 3 years. They basically went to, sort of, as I said, a 12 or 13% interest rate. That was clearly, unsustainable for the borrower. But so I asked this guy, and I said, so what's going to happen when these mortgages reset? And so the guy told me, well, so take a family, there's a little home, and, we give them a $500,000 mortgage, and then they come back 2 years later, and we give them another mortgage, maybe for $700,000. And so kind of like, sort of then we kind of figured out what was going on. And, so basically this was kind of like really sort of a treadmill where, sort of people got on, borrowed, got to the reset point in 2 or 3 years. Their house had appreciated. They got refinanced. They pulled out a little bit of money for themselves. They kept going. Then they did it again. And so then, sort of kind of like we put two and two together and we said, okay, so what happens when prices stop appreciating? You can't refinance. So then, that's and so that's kind of like the setup. And so in terms of conceptually, and so then we got to the data. And so what we found in the data was one that, home price appreciation had basically gone, I think was a 1.4% annual appreciation in real terms from something like 1980 to 2000. And so then we looked at the 2000 to 2005, and essentially the home prices had kind of exceeded the trend line by something like 40%. So we were in overpriced territory, and then we also saw that home price appreciation was slowing down. So then sort of the other piece of analysis we did was that there was a correlation between the severity of defaults and home price appreciation. And the thing is, there had never been really in the post-war economy a time when in nominal terms all of the nationwide average prices had declined in the United States on an annual basis, on a year-to-year basis. On the other hand, there were areas that had these different and negative maybe home price appreciation rates. And so we could basically compare the defaults in the areas with negative appreciation with defaults in the areas with positive appreciation. So we could create a little bit of a function that said, okay, if home price appreciation declines to this level, that's what's going to happen to defaults and so on and so forth. And putting those two things together, we concluded that if home price appreciation essentially leveled off, we would have losses that would be enough to wipe out the triple B tranche of most subprime securitizations. And so at that point, after 2 years of basically kind of like seeing this trade going from, you would make money on the trade if instead of having to pay 1% on a new CDS, you would have to pay 1.1%, 1.2%, sort of those would be sort of like the typical kind of returns you would see for about a couple of years. So that would be like, you have maybe an exposure of $1 million a year for 5 years. Say it's worth $5 million in present value terms or some amount close to that. And your position may fluctuate by 1%. So 1% on 5 million is $50,000. So from day to day, it would be sort of that order of magnitude. Then all of a sudden, sort of we're at the end of 2006 and prices were still the same. So we start loading up and we basically got, sort of over a period of like 6 months, we just in the credit fund, we got to something like $12 billion of gross exposure, which means we had bought protection on $12 billion of triple B tranches of subprime securitization.
Does that mean that you have capped your gain at 12 billion, or how is that structured?
Yeah, well, essentially, sort of like what seemed to be the wildest, sort of outcome was that we would get 100% of what we had insured against.
Is this what you paid about 100 million for? Am I correct there?
Well, sort of, yeah, we had sort of different type of trades and then like prices started going up. So we probably paid up to maybe 200 basis points on triple B tranches, but then we also started buying protection on different tranches. Ultimately, we bought also, we did a lot of work also on the CDO space, which essentially is, if you have an RMBS is a pool of mortgages, a CDO, a structured credit CDO, is a pool of RMBS tranches.
Yeah.
So we basically started buying protection on collateralized debt obligations that contained residential mortgage-backed securities.
So when we talk about CDOs, I'm trying to think of what the movie The Big Short referred to CDOs as. Was it cat shit mixed with dog shit or something like that? I'm not sure what it... but how did it look like for you then? That's what I wondered, because in retrospect, it seems so easily.
Well, so the thing is that was another sideline accomplishment, which actually was important because, sort of anytime you can do a trade with some kind of structural advantage where basically you reduce your downside, you reduce your cost, and you keep your upside, that's, sort of always very powerful because, essentially it allows you to, ride out the market goes against you and so on. And so we had done these CDOs where we basically shorted the whole, sort of collateral in the CDO. It's kind of interesting because, frankly, just having this conversation without any sort of visual aid is not super easy to explain. But the idea is that we did several billion-dollar CDOs where typically we would have 100 names in the CDO, so 100 different securitizations. And basically, we paid to the CDO the CDS premium, and then they use the CDS premium to pay for the securities that finance the CDO. So basically, there were people out there who would buy the $1 billion worth of bonds that were then used to create the collateral for our CDS, our insurance. So basically, we had that pool of money. And then we also bought the equity of the CDO, which was the lowest level of the financing, which obviously was always going to be wiped out, but also had a very high current cash flow. What would happen over a period of 1, 2, or 3 years is that we would really save a lot of money relative to just buying the CDS outright. And then, sort of also, we did it. So if we had gone in the market and started buying CDS aggressively like that, what would have happened is that the prices would have gone up. Instead, doing this with a CDO kind of essentially insulated us from, kind of like the market and didn't allow the market to really take off. So basically, sort of like we with all of these different, techniques and things, we basically were very well positioned by the mid of 2007. And then after that, we stopped doing anything.
So the structure of the way you structured it was as important as the idea. Is that what you're saying?
Well, what I'm saying is that I look back at it and frankly, sort of, it's not just me, but I think that John was amazing in the sense that, he really had his own money at stake. He had his own franchise at stake, and he was willing to pull the trigger on this. But we went from knowing nothing to be the best positioned sort of kind of financial entity in the marketplace. We sort of had the best so-called ISDA master agreements, which were sort of like the agreements that govern the exchange of collateral with banks. At some point, we had
Was your ISDA with Bear Stearns only?
We had ISDAs with everybody.
Okay, so your counterparties were everybody's. You spread it around?
Yeah, totally. I mean, so actually, we didn't do a lot of business with Bear Stearns because, so somehow they kind of like turned against us because, I don't know, they probably understood that we were, they knew that it was not going to end well for the subprime market, and they wanted to.
Oh, really? They did that? They knew that?
Yeah. I mean, so there was a time when we were even going down to Washington, explaining to the SEC that Bear Stearns was talking to clients and saying that they were going to essentially manipulate the market to sort of make our CDS worthless, that they were going to buy mortgages out of securitization pools and stuff like that, which if the subprime crisis had not developed to the same extent, and if, say, the Federal Reserve had started quantitative easing a year earlier, might have worked, sort of like if they...
It's interesting that you say that because just an hour ago, I was talking to a former hedge fund manager, and we were talking about how banks operate. And there are so many anecdotes about banks being sort of destructive in a way when it comes to influencing their market power, and that they often will protect the bank's interest above all else. Is that kind of what you're getting at? Like they're trying to undermine kind of the market in a way?
Well, I mean, sort of like it's very, I don't think it's reasonable to be to generalize too much. I mean, I think that there are problems with the banks that kind of like came out of the financial crisis because, essentially the decision and the reason why Tim Geithner is so popular with financial types is that he basically said, okay, we're going to just let the banks run as monopolies. We're going to make it impossible for anybody else to compete with them. We'll let them merge, consolidate, and earn excess returns so that they can rebuild their capital. And so, sort of at this point, it's, I think it's, that's one of the side effects of, the response to the financial crisis. But at the time, the idea was that, sort of people in subprime were, sort of really very confident in their story, and they were maybe a little arrogant, and they thought that they actually could, so they had always sort of another ace up their sleeve to essentially keep the market going.
Yeah, but that moves us to the crux of the story, which is probably the most interesting part, which is you sitting in an office coming up with this idea. The first little bit of crumbs of an idea that developed into a trade, that developed into the Big Short with hundreds of millions of dollars maybe, and hundreds and tens of billions in exposure. So what do you do in that situation when everyone is bullish? And people who are listening to this are often young, so young that when this was happening, 2006, 2007, 2008, they were still they didn't know about finance. And even people who were in finance then, especially in Norway, probably didn't really see the froth in the market and how people on Wall Street behaved. Because it was maybe one of the more bullish times we've ever had, where it seemed so like you couldn't not become rich. So what does it feel like going day to day and betting against that? What do you meet? What kind of what is your meeting with Goldman Sachs, with JP Morgan, with Morgan Stanley, these types of, or Bear Stearns, when you try to buy these products? Are they face to face, or are you doing this over the phone or on a Bloomberg? And what kind of discussions are you having with your investors and the like?
Well, I think it's interesting because by the time we went out to investors, we really had a very, very tight story, which essentially covered what I described, which is the structure of these mortgage securitizations, the relationship between home price appreciation and credit losses, and sort of the dynamics of home price appreciation. And we also had sort of a discussion of our CDO structures. And I think it was enough of a story and well articulated that people chose to give us money despite the fact that we had no track record in the industry. In fact, sort of like it was a little crazy to give to a merger arbitrage specialist money to sort of do this crazy trade in mortgage-backed securities. And so a friend of mine who ran a very successful, large, sort of multi-strategy hedge fund that had been in sort of classmate at Harvard with me, and he told me, "Look, Paolo, that just doesn't make any sense. Sort of like Americans pay their mortgage before they pay for their food." Other people were saying other things like, "Yeah, mortgages. You're confused. You think that mortgages don't stop paying when home price appreciation goes down. In reality, mortgages stop paying when the economy goes bad." That, and of course, the economy going bad and home prices going down are correlated. But so we basically we had to continue to think and focus. But what helped was the fact that we realized that the people who were talking down our thesis were people who basically whose income depended on sticking with their story, because these were not people who were kind of like could go either long or short. They were all people who made money through the whole process of originating securities, combining them into pools, and then selling them to investors, and then recombining them into CDOs, and then selling them to other investors. So it was a gravy train of fees for all these people, with essentially playing with other people's money. They were pretty sort of nasty. I mean, they called us tourist investors at conferences, meeting the audience, and the speaker. Well, I know that there are tourist investors here who don't believe in the soundness of our products, and they're obviously completely mistaken, and they're going to be sorry for doing this. So it's I mean, I think it's important to do your homework and then kind of stick to the evidence rather than just be intellectually intimidated by people who kind of have ulterior motives.
Yeah. But it's very difficult. It's very difficult to be. People always say, especially in hedge funds, that contrarian this, contrarian that, and everyone's talking about contrarian. But being a true contrarian is difficult. People tell you you're an idiot, and you start believing, hey, am I an idiot?
When the SEC started investigating all these things, sounded like a slam dunk, and we were the ones duping other people into. so it's kind of like, it's an interesting going through the looking glass type of experience.
Were you playing dumb when you say you were duping? Like you knew what would happen, you were so confident? Am I understanding you correctly?
Basically, sort of like the idea is that, and the reality is that we had done all the work, and we obviously had a point of view, but we didn't set up any kind of information that everybody else didn't have. And frankly, I was actually at some point, I was really talking up our trade, so I was, talking to people pretty freely about the fact that, I thought that explaining the relationship between home price appreciation and losses, and saying, look, these obviously is going to sort of end one way. And that might have prevented us from getting even more, even an even larger position. Could have gone on for longer, but also wanted to be sure that we were actually making money.
So you felt that you talked yourself down in a way by being open about it, that it could have been better? Is that what you mean?
Honestly, I could have been more circumspect, less open about our views, because for a long while it was important to continue to have counterparties who were willing to take these trades. The minute people agreed with our thesis, the market would change. The opportunity would go away, which is what happened. So
we've heard stories about people that say, like you briefly mentioned, that Bear Stearns would buy up assets to affect the index, and there has been stories about. There's been talk about, especially things like Goldman Sachs, where they got on the other side of the trade before the trade moved. Is that just theories, or did that really happen, that the banks caught on to what was happening, they got on the right side of the trade, and then it started to move? Or is that just a crazy conspiracy theory?
No, the idea is that Goldman Sachs and JP Morgan, which before the acquisition of Bear Stearns was not particularly big in the space, started basically hedging their positions. We use Goldman a lot, and we came around to our point of view.
Okay. Because front running is a huge problem, especially with exotic trades. This is a smaller market. So I'm wondering How do you really mitigate that risk in such a specialized trade?
When you talk about front running, front running is when a customer is placing a large order and you go and essentially move the market against your customer and then dump it on the customer. So, I don't know, sort of maybe Goldman front ran the market against us. But, the reality is that the way we built our positions is we did the daily auctions and we solicited bids from all over the street. So we basically had 10 different firms bidding on hundreds of securities.
That sounds very smart. It sounds that the structure was very important in your trade. Again,
other people did the same thing, and they came out okay. Like Jeff Green learned about the trade because we tried to sort of get him into our fund and replicated the trade, and it still came out ahead. So, but obviously it couldn't be as leveraged, and probably had some sweaty nights when he was trying to unwind the trade because, again, when we unwound the trade, we were doing, again, auctions with everybody. Other investors may have been in different relationships with their counterparties. They may not have been able to assign their trades to others. So it's kind of like, so it's a whole set of logistics for being in the business for zero to sort of from starting from zero for 2 years, sort of we basically were kind of going head to head with the Goldmans and the JP Morgans and the UBSs and the CSFBs and Bear Stearns and everybody else.
Yeah. Do you remember the numbers when you closed the position, when it happened, what the final tally looked like? And I've heard the number 600% returns. Is that the correct one?
No, I mean, sort of the first credit fund basically had a 12 times pre-fees returns and 10 times.
12 times? Jesus.
Yeah. And then the second fund had, 6 times and pre-fees, 5 times after fees. But then there was also huge returns in all the other funds that basically had taken positions, essentially sort of characterizing them as market hedges. Because the cost was so low, they could afford to sort of put in these huge market hedges that ended up putting them in a net short position. And so they also had a huge return. But between Paulson started with 3.5 billion assets under management when I joined in probably also was 3.3 billion. And we finished at the end of 2008, we had 36 billion.
Holy shit.
So that's a combination.
God. That is a big fund.
Gains and additional subscriptions. But I'd say the gains were the largest part of it. And obviously, John also did a great job in terms of shorting the banks in 2008.
Yeah, that was my next question. He bought puts on the banks, right?
Well, not puts. He basically shorted, and he shorted before the ban on shorting went into effect, so he could basically continue to hold his shorts all the way down to zero.
Oh wow!
Or close to zero.
That's an amazing trade. It is considered the best trade in history. Is it? Depending on how you view the term trade, I guess. Since it's fairly short time span, I guess it's the best ever.
Yeah, I don't know. So, I mean, I think that, sort of like there was something about Citadel basically making more money last year than we did in the subprime trade. I'm not sure whether I think there is a Rothschild entity in Switzerland that keeps track of how much people contributed to their investors, and of course Warren Buffett is high up there. And
the people who invested in Warren Buffett in the 60s, I think, is considered the best investment in history. There was a married couple, and they put in, I think, $10,000, and they got billions out. And I think that's considered the best, like nominally, especially considered inflation. But I think it's fair to say that the Paulson short that you had the idea of is the best trade ever.
Well, I mean, it's
quite a compliment. It's quite a CV builder.
Well, I mean, so I think the reality is that if you think about at this point the rich people, you think about Musk, you think about Bezos. There was a lot more money in a bunch of the things, so in the long trades of the last decade, so essentially, so like that was the probably sort of it should be called the best short ever, because so I think you can make a lot more money on the long side.
But it was your idea. I mean, it really is quite special. And I heard some stories about your bonus. Do you want to talk about it, or is that something you rather not talk about?
I'd rather not talk about it specifically, but it's all over the internet. So
yeah, it's quite big. Did you have shares in the funds or parts in the?
I negotiated with John a share of the performance fees for the credit fund.
Yeah, and that was a 220 fund, 220.
I'm not sure whether it was 2 and 20 or 1 and 20. Let me think.
Still, it's the 20 part that's important.
Yeah.
That's quite amazing. The fees must have been unbelievable.
Yeah.
And everybody made money. It's amazing.
John made most of the money.
Yeah, of course. But how did you celebrate, you and John?
How did we celebrate?
You didn't celebrate?
Well, we had an investor dinner at the end of 2007. Maybe that was a celebration. Christmas sort of party for everybody. So we did that. The thing is, it's important when you do that kind of stuff, it's important to sort of keep a cool head, don't sort of get ahead of yourself. Frankly, so I was always sort of watching for the potential of reversal of fortune.
Yeah. And you launched your own fund after that, right?
Yeah. But, I think that it was like another big hedge fund manager told me, well, you're going to start your fund, and you will discover what you can and what you cannot do. So it's, I think a trade is a trade. Running a fund is basically like running a business. You need to have a routine, a model and so I really didn't have that because, so my success was basically on an ad hoc analysis of particular market situation. And so obviously that kind of situation did not repeat itself.
And I've heard you say something that's not so common. When you closed the fund, was it 2010, 2011?
2010.
And you said that you didn't want the investors to have unrealistic expectations. So you rather give the money back. That's quite an adult decision. Very unusual in finance.
Unfortunately, there wasn't so to me, it was kind of important to, if I wanted to do a fund, to have something distinctive to offer. And the thing that I thought was distinctive was the fact that I had spent a lot of time thinking about the issue of chronic weakness of demand, and therefore the likelihood that there would be fragility in the economy. The reality is that, there's always the saying, don't fight the Fed. And, the Fed is really sort of hugely powerful. And essentially sort of like most of what happens is just a function of essentially where is the current ideological point of view at the Fed. Before, the financial crisis, sort of there was this notion, and I think that Alan Greenspan sort of put it this way, so basically that banks have a sense of self-preservation. They're smart, and if you basically don't create moral hazard, essentially the system is going to balance itself. And they tried for a little bit to sort of stick to that view during the financial crisis. They got to the Lehman failure. Then after that, they say, sort of screw it. We're just not going to have any of these constraints. We're just going to kind of like, sort of essentially support the market. And so I think the more you push this type of approach, the more sort of eventual instability you really are going to encounter. So the issue is that for me, I realized that my approach, my sort of outlook was basically inconsistent with the reality. I mean, sort of to some extent, I think that having done so well on that trade and having done so many things right, it's easy to feel that, you really sort of have extraordinary powers beyond sort of anybody else's. And the reality is that there are a lot of smart people out there. There are a lot of people who work very hard. They work effectively as part of large organizations with routines and methods to sort of tackle problems. And, so it's kind of like important to be sort of very humble. And it's kind of like difficult to be humble. And it's also difficult not to sort of set yourself unrealistic goals after you have such a great success.
Your perspective is so pure, I think, and you see the fact that you're able to see your own lack of abilities when you've made what many people consider the best trade ever, even though it's not has your name on it, has Paulson's name on it.
I have seen a lot of people basically go from hero to zero.
Yeah, exactly.
From zero to hero and the other way around. I think that's something to keep in mind. It's important to sort of basically, and from my perspective, at some point, sort of I felt that it's kind of interesting because Peter Thiel had, let's say, one failure in his career, and I think that was the Clarium Fund. But basically, we had the same point of view at that point. I remember we were at the conference, and one of his manager, he was there, but one of his managers sort of addressed the audience and sort of like talking about the situation. Basically, that was maybe a couple of months before I closed my fund. We were both sort of like negative about prospects for the economy, and the economy was, in fairness, going down, except that the Federal Reserve at the Jackson Hole meeting that year decided to just restart the QE forever. So, sort of like you can't fight that. But basically, sort of the Clarion investors lost 90+% of their investment, and they were very, very upset about it because they couldn't do anything about it. It's kind of like the terms of the fund sort of prevented them from taking money out and so on and so forth. So it's not like I'm not in good company. Now, of course, Peter Thiel has done a lot of other good things, and so
he's done some bad as well.
Not okay, but sort of I think that it's important to just avoid sticking to something that you don't. Basically, sort of once you realize that you don't understand what's going on, so you need to sort of get out of it.
Cut the trade. And I mean, it's the oldest adage in finance: cut your losses and let your winners ride. And you have your big sort of home run, which I'm sure you've managed well. Have you managed it well after the hedge fund was shut down?
I've managed it, sort of reasonably well, but so definitely not in line with market gains.
Yeah, but you haven't lost it. That's the point.
I mean, to me, sort of that's kind of like important. Sort of I think that look. The thing is that John, at this point, has probably less money than he had, certainly at the end of 2008.
Yeah, and also, like you mentioned, that he put his business on. He also put his reputation behind the trade, and sadly for him, because of his trading after, he has lost that reputation to some extent as well.
I don't think he has lost, really, he hasn't lost anything. $5 billion is still $5 billion.
No, not money. I'm not talking about money. I'm talking about people thinking you're literally God.
Yeah, I mean, but the reality is that, sort of he made a lot of mistakes too. And I think that part of it was that he probably had it's a mix of things. Essentially, sort of one is starting to focus on unfamiliar issues and processes, and the other one is just having this outsized ambition that it's kind of like you got to sort of follow up with something to the greatest trade ever, and so that's kind of like very dangerous.
Yeah. So the what is it, $100 million question right now? I guess 100 million isn't what it used to be, but what do you think about the current situation?
Well, it's sort of a strange. It's similar to 2008, or maybe earlier, maybe 2007, in the sense that, so the way we got out of the financial crisis is that, sort of both Bernanke and Paul Krugman had this view that in order to get out of the liquidity trap, which was essentially where we were with low inflation or negative inflation, zero rates, and so on and so forth, basically the central bank has to appear credibly irresponsible. So let's say, we're going to create so much inflation, you won't know what hit you. And so basically, that was kind of like, finally realized in the last 12 months or so. And now, sort of all of a sudden, obviously, there is sort of another point of view that has emerged. But, sort of like up to 12 months ago, you could have easily assumed that the Fed was going to be happy to let inflation run for a while, at least for a while. We kind of like forgot that there was this whole notion of, sort of since we've had low inflation for so long, we need to sort of give inflation a little bit of time to catch up. And then all of a sudden, then the Fed says, no, we want to get inflation back to 2% sustainably, and That's a huge change of approach. So it's kind of like a tricky situation. And again, I think that the crises are possible only when the Fed imposes constraints on itself. I'd say, inflation is a crisis too, of a different type. I mean, it's not a crisis for debt holders. It's not a crisis for capital holders. It's kind of like, you basically just inflate everything, So it's a crisis for basically people who are, for pensioners, more than anybody else. But but to the extent that the Fed decides to impose constraints on itself, then who knows what's going to happen?
What do you think will happen?
So I am looking for, sort of a bottom at the S&P 3000 or so. That seems to me would be a reasonable place to get to and then bounce up. But at the same time, we're kind of like going a little sideways, at this level, so as people just gauge how far the Fed is going to go. And also sort of like, the reality is that the data is very volatile. After the PC deflator release, sort of basically people all of a sudden say, well, maybe inflation is not going down. Sort of the release a month earlier, it looked like, oh, we've done it. Inflation is now down. It's kind of like going back to 2% or even less. Actually, we should start being concerned. So the fact is, if you take the last reading of inflation, the real interest rates are still essentially at zero. So is that restrictive? So I don't think so. But, at the same time, so there are other things that are going to be restrictive, because after the pandemic, sort of the big thesis for Jamie Dimon, the CEO of JP Morgan, was that U.S. consumers had $2 trillion of cash that they didn't have before the crisis. And so that was kind of going to support the economy, which, I think is kind of like still happening. But it gives you sort of an idea that there is an element here that is unsustainable, which is basically a fiscal stimulus impulse that is basically dying off. And so what happens once that's gone? Because, so in my opinion, so the reason why the US economy sort of had the problem, there was credit stop. But, part of that was that Alan Greenspan had essentially engineered these sort of supplement to demand in the US economy by having this so-called home equity extraction process. So this idea that people kept refinancing their appreciating homes and basically taking money out and spending it. So then the minute you sort of get, so even small amounts of relative to the size of the economy, say 1%, 2%, 3% of this external sort of flow of demand that is not based on income, but is based on increasing borrowings. Once you take that out, the economy sort of like turns on relatively little amounts at the margin. And then sort of if you get into a downward trajectory, then, it takes a fair amount of effort to reverse that. So, I mean, sort of the thing is at some point, sort of some of these sources of demand based on appreciation of assets and stimulus payments as well, they're not going to be there. And so then when that happens, sort of like the economy has to adjust. And so if you take demand out, then you're going to take income out, then you're going to take demand out, and it's going to ratchet down until it gets to some bottom where it can bounce again.
I want to thank you so much for taking time to talk to us. It's been amazing. And it's been amazing to hear your point of view.
All right. Thank you.